I'd like to welcome in Marc Chandler. He's the Chief Market Strategist at Bannockburn. Marc, it's great to have you back with us. U.S.-China tensions have been ratcheting up some this week ahead of meetings later on, tomorrow and Friday. Should we be ratcheting down our expectations of an outcome?
Yes, I think that expectations should be very low. You know, look at what's happened in the last couple of days. The U.S. opened up a new front on China by sanctioning about almost 24 companies, not on national security grounds like we have in the past, but this is on human rights violations and their assistance in the suppressing of Muslims in that one Chinese province. In addition to that, China's fighting back too. Look at what they did to the NBA. And just last night, they decided to censor one of the South Park, the irreverent show, but they decided to censor that South Park episode. And so, and earlier today, the U.S. Made new sanctions on individuals in China responsible for that suppression. So I think that the multifaceted struggle between the U.S. and China continues. And I think that China is announcing today that they're willing to buy more U.S. soy and more U.S. agricultural products. But this is not a goodwill gesture. This is primarily, China has a shortage of protein, both animal protein and plant protein. So that's pork, beef, and soy that China desperately needs.
Yeah, it's interesting how it's being spun off as a good faith gesture. It seems like it's more market need, though. Let's talk a little bit about the impact this could have on the U.S. economy, because we're hearing a lot of talk about the dent that it's going to have on GDP, but I'm wondering if this is actually starting to, this drawn-out process is going to weigh on the consumer at this point. I mean, are we losing the consumer's faith? And ultimately, I wonder if we're starting to see that develop. I mean, we've seen some disappointing numbers recently in terms of not only the ISM, not only the manufacturing side, but also spending recently in the income and spending reports. And basically, I'm wondering if it's starting to catch up with the consumer, because they seem to be the pillar of strength still at this point in terms of the U.S. economy.
Yeah, but you raise a really important point. I was just reading a paper by some professors at NYU, and they're arguing that if you look at more at a nuanced level of where U.S. auto sales are weakening, those auto sales are weakening in those agricultural rural areas that have been hit by the counter tariffs. And so there does seem to be, at least from this paper, some linkages between consumer purchases and those tariffs. And of course, we're expecting another round October 15th and then again in December. So I am concerned about the consumer, but I still think that the labor market is still strong enough. We saw that unemployment rate fall, even though the labor force participation rate did not change. So I think the labor market's still healthy, consumer is still healthy, and we just saw yesterday that bigger than expected jump in consumer credit. And it wasn't so much revolving this time, so it seemed to me maybe some student loans in there as well. But in general, it seems to me the consumer is still ticking along, and we should be expecting something like trend growth in Q3 and in Q4, which is just around 2%.
Okay. Marc, yesterday Jerome Powell informed us that the Fed's going to start growing its balance sheet again. Powell stressed, and I quote, "This is not QE. In no sense is this QE." Is it, Marc?
I don't think so, but I think that there's a lot of confusion about this. I think there's a lot of people, I think that there's a real split here between the retail community, which is suspicious of Washington and suspicious of these kinds of things, and of course government denials, and the institutional analysis. And I really am more part of that institutional analysis that says a couple things. One is the Fed's balance sheet typically before the great financial crisis was expanding almost every year. So all Fed balance sheet expansion is not QE. Another factor that differs from this is under QE, the Fed was doing huge size, say $85 billion a month. Now we're talking about something like $100 billion, and also Fed buying T-bills rather than bonds. The signaling effect is also different.
All right, significantly less. Marc, I wanted to get your thoughts on Jerome Powell mentioned how he and his colleagues will soon announce measures to add to supply of reserves over time. Today, we get the Fed minutes, possibly some insight there. I mean, the details are important here in terms of how they're going to go about this process, correct?
Yeah, so I think that, I was in the camp that thought the Fed had a problem in the repo market and would address the repo market directly by having a new facility to make it not just an ad hoc basis. But the Federal Reserve seems to be going back to the organic balance sheet. But I think that the importance to me of what Powell said was that he said that this announcement was going to be in a couple of days, which seemed to me to signal before the end of the month FOMC meeting. I had thought the Fed would keep that late October FOMC meeting clear to address the plumbing, allowing a rate cut in December. But now, with Powell's comments, I think the odds of an October rate cut have increased markedly.
Let's talk a little bit about Brexit here, Mark. I saw that the Irish Prime Minister said he doesn't think a deal is possible. There's been some hard-nosed rhetoric this week, to say the least. Seems we've shifted back to the blame game this week and lost sight of the initiative once again. Next week we have Brexit, U.S.-China trade tariffs, EU tariffs, and I guess I'm wondering if this all could be the straw that breaks the camel's back in terms of the U.S. dollar. I know you've been somewhat skeptical of the bid that we've been seeing and it holding these upper levels. What are your thoughts?
Yeah, so I am concerned about these risks. Brexit in particular, I think that, I don't know how it actually takes place, but I do think that there will be an extension. I was looking at predicted.org, and they've got like an 80% chance that Brexit does not take place at the end of the month. In general, though, I still think we need to have, from my view on the dollar to be right, I think we need some positive news from Europe, and we're really not getting it, despite the uptick in German industrial production. We're still getting bad news from Europe, bad news from Japan. They just hiked their sales tax. And so I can see the dollar struggling, but I think for the dollar to really turn down, we need to have some positive news elsewhere.
All right, well, we'll be keeping an eye on that. Mark, really appreciate you participating, joining us here this morning to talk currencies, and join us here on the TD Ameritrade Network. Traders, that's Marc Chandler, the Chief Market Strategist at Bannockburn.